What if an airline that everyone trusts, a highly profitable carrier famous for its operational excellence, suddenly found itself in a catastrophic financial freefall? Welcome to Air Flight Space. Today, we're unpacking the story of a flagship carrier fighting a sudden, massive downdraft. It really begs the question, doesn't it? How does an industry leader suddenly experience such an overwhelming external shock to its operations? Because behind this recent announcement, well, there's a much bigger story here about volatile global markets, fragile aerospace supply chains, and the harsh, unforgiving economics of modern aviation. We're not just looking at a bad quarter. We're looking at an airline fighting to navigate unprecedented turbulence. And the sheer scale of this shock, it is literally breathtaking. We're talking about a projected full-year pre-tax loss plummeting all the way down to negative 390 million New Zealand dollars. To put that into perspective, that's up to 231 million US dollars, practically evaporating from the balance sheet. So this isn't just a minor course correction, right? This is a full-blown financial nosedive that threatens the stability of their entire network. In today's explainer, we're going to map this out across 5 clear stages. First, the financial nosedive. Then, volatile fuel, the passenger drop, their lifeline strategy, and finally, fleet recovery. Part 1, financial nosedive. Let's look at this drastic shift from profit to loss. There is a truly violent contrast in the data here. Look, for the year ending June 2025, Air New Zealand reported a really healthy pre-tax profit of 189 million New Zealand dollars. I mean, they were flying high. But fast forward to the forecast for the year ending June 2026, and we're seeing a staggering projected loss of up to negative 390 million. The warning signs actually flashed early with a 59 million loss in the half year to December 2025. This rapid, massive fall from profitability to a devastating loss is honestly a textbook example of just how quickly the global aviation environment can turn hostile. It leaves us asking, what exactly caused this massive drop in altitude? Moving to part 2, volatile fuel, the twin engines of this crisis. Okay, so to really understand this, we need to dive into the mechanics of airline finance for a second, specifically fuel hedging. Now, for you aviation enthusiasts or anyone new to the business side of the aerospace sector, fuel hedging is essentially a financial insurance policy. Airlines use it to lock in fuel prices months or even years in advance. Basically, you buy contracts at a set price. That way, if the global energy market spikes, your operational costs stay predictable and your flights remain profitable. And this perfectly illustrates exactly where the system broke down. Look, Air New Zealand wasn't flying blind. They were actually highly protected, 85% hedged on Brent crude. Only 15% of their fuel needs were exposed to market volatility. But here's the technical catch. While the raw crude oil was hedged, the refining margins, the actual cost to turn that crude into usable jet fuel, absolutely skyrocketed. The scale and speed of those refining cost movements were so severe that just this 15 exposure pushed their expected annual fuel expenses a massive $240 million higher than forecast. It was a huge external shock that basically completely bypassed their financial armor. But here's the bigger question. What happens to an airline when surging operational costs collide head-on with shrinking revenues? That brings us to part 3, softening demand and the passenger drop. This demand drop is complex, and it's definitely multi-layered. Booking momentum, which was actually tracking ahead of fiscal 2025 initially, just hit a brick wall. Domestic and trans-Tasman demand have softened significantly, partly due to reduced sales activity in the region. At the same time, outbound demand to several long-haul markets is dropping, while inbound traffic from North America remains, well, mixed at best. It's a perfect example of how global economic instability directly impacts local flight operations. Because let's face it, when the cost of living goes up, the very first thing people cut is discretionary travel. So how do you stop the bleeding when fuel is incredibly expensive and your passenger seats are sitting empty? Well, you ground the flights. Air New Zealand was forced to make some tough operational reactions, cutting its overall group capacity by 3 to 5%. They actually executed 3 targeted capacity consolidations right after broader global conflicts and economic pressures started hitting the headlines. Now, in the aviation world, cutting capacity means literally fading routes off the map. You take planes out of the sky to avoid flying half-empty aircraft at a massive loss. We've seen the sheer scale of the crisis, but what exactly is the strategy to keep this airline alive? Let's dive into part 4, their lifeline strategy and the $400 million facility. To mitigate these steep losses, Air New Zealand is launching some massive austerity measures. First off, they're thoroughly reviewing all capital expenditure plans, essentially hitting the brakes on new big-ticket spending.
Second, they've accelerated a strategy refresh that began in late 2025, which unlocks up to 100 million New Zealand dollars in annual cost savings. But the absolute most critical move is happening right in the boardroom. They're finalizing a $400 million secured revolving credit facility. By borrowing against their unencumbered or debt-free aircraft, they're boosting their pro forma liquidity to approximately $670 million. It's a massive financial shield raised just to ensure they have the cash on hand to weather this storm. But there's a hidden layer to this story that isn't just about boardroom finance. It's about the physical hardware out on the tarmac.
Which leads us to part 5, fleet recovery and returning aircraft to service. You see, airlines globally have been dealing with this kind of silent operational killer: supply chain challenges and severe engine maintenance delays that just keep planes stuck in the hangar. Now, while their strategy refresh to cut costs began in late 2025, the real hardware relief doesn't come until later. By late June 2026, Air New Zealand expects all of its highly capable Boeing 787-9s to finally return to service. And looking even further ahead to the end of 2027, their Airbus narrowbodies will be back in action too, which means the airline can finally drop the incredibly expensive stopgap costs of leasing temporary replacement aircraft and engines. This quote directly from the airline really hits the nail on the head regarding why this hardware matters so much. They stated that improved aircraft availability will strengthen operational resilience and provide greater flexibility to deploy the airline's most fuel-efficient aircraft. Look, in a high fuel cost environment, having your newest, most aerodynamically efficient planes grounded is an absolute disaster. Getting them back on the flight line is absolutely crucial to their recovery. Hey, if you're passionate about aviation, aerospace tech, and the strategic business behind the skies, make sure to subscribe to Airflight Space and turn on those notifications so you never miss our future explainers. And that brings us to our final thought for today. The $400 million liquidity is secured, and the grounded fleets are slowly returning to the skies. But the global market remains incredibly volatile. So, do you think these massive austerity measures will be enough to transform and save the airline's future? Or are legacy carriers facing a permanent shift in how they must operate from now on? Let us know your insights down in the comments below. In aviation, today's experiments often become tomorrow's reality. Thanks for watching Airflight Space.